In this video, I'd like to explain why investors put their money in hedge funds and how they calculate if it's a good investment. Now, I've prepared a small drawing that might help you, and on the upper side, I have my MetaTrader platform where I am executing the trades. This is where I have the robot trading at its opening and closing positions. On the other side is my Darwin, where according to my risk ratio, certain lots are being opened, and as I showed in the previous video, if I have 1.7 lots in my MetaTrader, I would have 0.25 on my Darwin because my current risk ratio is 0.15. So on MetaTrader I have my trading going on, and on my Darwin it is a certain amount of lots that are replicated. Now in the middle I have the S&P 500, which is the benchmark. Now on average, S&P 500 brings 10% a year. On a profitable or losing month, it could be up or down 5%, and historically it might bring losses of 10%. Like, this is what happened until the moment through the years. But with simple words, if investors put their money into S&P 500, they expect 10% a year. Now, a good investment for investors is if they can make more than that. So the S&P 500 is used as a benchmark, and if the investors don't make more, they wouldn't put their money into the hedge fund. Now, if the S&P 500 is the benchmark and you trade Bitcoin, what is happening? You are riskier, right? So usually this will be replicated like that. You buy Bitcoin and you execute certain lots on MetaTrader, but on your Darwin it will be less compared to what it would be if you are just with the same risk as with the S&P 500. Alright, so the Bitcoin is riskier and the result is less trading on your Darwin, or pretty much the Darwinex Zero platform, the risk engine, they will lower the risk for the investors because you are trading a riskier asset. Now, let's say you are trading euro dollar conservatively. What would happen? Then it would be the opposite thing. If you execute fewer lots on MetaTrader, this will result as a higher lot on your Darwin. Now remember that the investors don't buy what you trade on MetaTrader, but what is replicated from your trading on the Darwin. And in my account, where I'm trading just the euro dollar, you can see that all trades in the history are with the euro dollar, but because it's a grid martingale system, the volume increases with the time, and my Darwin is set to 0.15, or if I have 1.7 as a lot, it executes on the Darwin 0.25. So even I'm trading euro dollar, but because I am trading it with huge amount from time to time, the lots are big on MetaTrader, but they are lowered with 0.15 as a ratio on my Darwin. So the risk engine is taking into consideration not just the asset, but the volume or the lots that I am trading, how much I'm holding the trades, and a few different factors that predefine this risk ratio. And one more time, it's not about to aim the returns of S&P 500, but more about consistent risk. So if the investors know Petko's risk and it's not enough for them, so let's say they want more, they can invest in my Darwin, but because my risk is the same or it is constant, they would need either to put more money into my Darwin or they need to increase the leverage of their account. So these are the two ways the investors can put more risk on my Darwin. They cannot change my Darwin risk. It is what it is. If they want to risk more based on my Darwin, then they would either put more money or increase their leverage. But this is what the investors are looking for: consistency and a risk they know, so they will decide how to trade or how to invest their funds. If this video was useful, I'll be really happy, guys. If you have questions, let me know. I hope it's not too nerdy, but I really want to explain how it works so you will know how to manage your account, and most importantly, you will learn how to manage your risk so it is consistent and it's not changing, and the Darwinex is doing its job. But of course, it depends on you to show that you are profitable in the long term with a consistent and stable risk. That is the target when trading as a hedge fund manager.